All right, I've got a lot of requests to put my business hat back on, and I'm going to do it. So I'm going to dive into the economics of sports cards. I've got graduate level experience in economics, successful entrepreneur for a couple decades, retired at 40, and I think I can give some interesting perspective on FOMO, or the fear of missing out, and also how to identify bubbles in the sports card market. You'll be able to look at specific players and look around and say, hey, is this an asset that's in a bubble? I'll even help you time where it is in the bubble cycle. All right, this is one of my favorite charts of all time. This is the Dutch tulip craze in the 1600s. Technically, it lasted 3 years, but the actual bubble movement was over a year. And it is the first known charted actual bubble. What happened at the peak was a tulip. I'm not joking, a tulip bulb was the price of a Dutch house. So just get that through your head for a second. And what is most interesting, a specific hybrid variety, one with almost like a striped look to it, was the most expensive one. And you could have gotten 3 or 4 houses. It was over 200 times the price of gold for that specific bulb. And I'm wondering, what does that remind me of right now? This is your classic bubble chart. I'm going to go through each phase, and I think it will help you understand what phase you're in when it comes to the particular collectible or the player that you're investing in, because there's important things that you can see at each stage as clues. And the reason I think that this will actually apply to sports cards is that business relies on performance, and players also rely on performance, and performance can change on a dime. And I'm going to make sure you're not the last one sitting on the musical chair. Phase 1 is smart money, aka insider trading. Smart money essentially means you've got a tip from a buddy on Wall Street, something's going to pop, and you're smart to the play. And you're going to actually get ahead of the curve. All the institutional investors, you're going to make bank on this. It's a gray area, sometimes even illegal. So that's how it happens with stocks. With a sports player, I think the equivalent would be something like, the personal trainer, or you're a cousin of the coach and he's going to be called up from single A, or he's going to be named the starter on the NBA team, or et cetera, et cetera. Like just some sort of inside knowledge as to something that's going to pop for that player. The next phase of a bubble is the institutional investors. So what happens is smart money gets around, and smart money doesn't stay quiet for long. Now you've got your Black Rocks and your just massive, like big money players. They've got people dialed into the pulse of stocks, and they will say, okay, we've got a play here, and throw a few $1 billion at it. So the equivalent here in sports cards, this one is a little bit tough. I guess it would be somebody with deeper pockets that can buy, the logo man of a player that's going to pop, or the one of one flawless, or the PSA 10 rookie card, Bowman Chrome, like something like that, where you've got the smart money, but you've got the funds to back it up, and you can be a whale. And that's what happens next. This is all before the public has any sense of what's going on. We are blissfully unaware that this is happening. This is exactly what happens with stocks as well. All right, phase 3, when the public starts to get involved. This particular player, take like Wander Franco. That's a great example. All of a sudden, he's batting 400, or he's batting 300, or an NBA player's taken off and it looks like he's going to be named to his first All-Star team. The media starts to get involved. Public attention is there. And when you're about halfway up this phase, it's too late. The smart money has made their money. The institutional investors have made their money. And you maybe can get the last 20, 30% of it, but it's going to be tough. Again, the word is out, right? The word is out, and you have to be quick about this and decisive about a particular player. So Wander Franco, he obviously popped, was doing really well. And then we enter phase 4, where there's a lot of clues here. There's delusion. This player is going to be a Hall of Famer. He's going to be a GOAT. Greed. You'll have influencers touting this player, trying to pump up the market. and you think like, hey, this is the place to stay. This card is going to be this price forever. You actually convince yourself this, and this starts to go on the downward side of the curve where you're sort of in the denial phase. And then before we enter phase 4, some sort of cataclysmic event happens in a stock. That could be, there's a bad audit at the company. They had a bad quarter. Company's going to get bought out. The company's drug failed the FDA approval process. There's a zillion scenarios. For a sports player, it could just be an injury. It could be assault charges. It could be just something really major that changes the game. That is your event that changes everything. And you start to come down this very built up, very fast curve. And this is the phase that sucks. And most of the public gets jammed. And a lot of people feel pain, except for the smart money and the institutional investors who bought so low, it does not matter. So we've had this event. There's this denial phase. You'll get this little extra bump. You've worked your way down. Oh crap, there's assault charges, but he's going to get off and he's going to be a great player. Don't worry about it. Well, you think you're returning to normal, but then it tanks. And it tanks like 80% very quickly. You've got fear and this, oh no, what's happening? The public sells their stuff at a loss. Again, smart money institutional investors, they don't care. They've made their money. They're fat off of the profits from the ride up. And they're just laughing as the public takes this ride down. The equivalent in sports cards is tough because the whole market, obviously, it's so much of a kaleidoscope that it moves differently. You've got a vintage signed Pistol Pete card. It's going to move a lot differently than a Wembanyama black 1/1, right? But within different categories, and within different players and cards, you can probably see this bubble happen. The bubble could happen over a month. The bubble could happen over a year. The bubble could happen over a week, depending on the speed of news and information. People start getting worried. That's where you see your eBay listings. There's like 500 of that player, and it's the catch a falling knife syndrome. They're all trying to underbid each other before the knife just falls to the ground, and they just get bloody on the way down. These are all terms Wall Street guys use. So you've worked your way to the bottom, and then we get the most interesting phase of all. All right, this is something the hedge funds will call a dead cat bounce. It's a pretty gross term, but what it means is that at the bottom of a fall like this, anything is bound to bounce up because, again, those smart money and institutional investors that bought in, now the price is actually lower than when they bought it before. So they're like, maybe I can get a quick return on the stupidity of the public, right? So they call it dead cat bounce because even a dead cat will bounce if you drop it off of a building. So it's like saying any stock or any asset will bounce. So with Wander Franco, again, right? Okay, he's never going to play again. He's going to jail. He's got these allegations. But maybe it crashes so low that you're like, hey, what if he gets off on these charges and in 5 years reinvents his image like Michael Vick or something like that? And hey, you take a stab. It was selling for $1 on eBay. Now you're like, you know what? $1.20. Why not? And you get this little, return to the mean, and then things start to even out. So how do you know what part of a bubble curve that you're on? If I knew the definitive answer, I'd have billions of dollars. So there's no perfect way to tell, but there are whispers. The smart money phase, you're not going to know about unless you are part of that intricate group of people that has that inside knowledge. The institutional investor phase, same thing. The only way you're going to know that is if you are an accredited investor investing a certain amount of money each year. Your financial advisor might come to you and say, hey, BlackRock's throwing $200,000-300,000 grand of our allocation into this play. Do you want to be part of it? So you're not going to see anything there. The public is when it starts to happen. That's why I say when there's public news about a player, it's almost too late, just like with a stock. Over enthusiasm, too much media attention. Go on Google Trends, type in that player. If you see a pop there, you're in that public part of the curve. Delusion and greed. Are influencers trying to pump this? Are influencers buying this? Are stupid people buying this? Like, there's people that you respect in the hobby and there's stupid people in the hobby. What are the people that you respect doing and what are the dumb people doing? If the dumb people are going after something in droves, guess what? It's probably dumb and you're probably right before the peak of this curve. And on the way down, it's over. Like when there's bad news about something, the game is over. And before that knife falls and the hands get bloody, sell it, sell it, sell it. It's not a perfect strategy. There's a chance that the news is incorrect or whatever. But in most cases, you are at the top of a bubble and you can call it and avoid all the nastiness of the ride down. And how do you know you're in the downward trend? That one's the easiest one. Prices have consistently fell for a period of time, and there's chatter and there's fear, and you know you're there, right? Now, I do want to mention again, this is not a perfect analogy. The sports car market is different than the stock market. The stock market's actually liquid because you can trade at the push of a button. The sports car market is not, because you've got to go to a card show. You've got to sell it. You've got to sell it for a certain percentage of comps. You've got to list on eBay. You've got to wait 7 days or 1 day for the auction to end, pay the taxes, wait to ship it. It's not perfectly liquid, so it doesn't move as fast as the stock market. Plus, you have so many different pockets of behavior. A 1952 mantle collector, that is so different than like some modern one of one, card or whatever. That mantle is more like an art asset class that moves much slower, whereas a modern player that's still playing and their one of one's going to fluctuate a lot more differently. I mean, I could probably talk for 2 hours about the differences, but I think the most important message of this video is to just understand bubble economics. When people have a fear of missing out, the FOMO, it is almost always a bad human behavior. Because right now, if you have the fear of missing out, you have the fear of like a profit not being as good as it could be in the future. And that's a terrible, terrible way to collect. That's a terrible way to invest. Use your head and do the research, and maybe you'll actually be part of that smart money curve that's really, really dialed into a particular player. And don't follow the media and the influencers' advice on what to buy. That's almost always a bad decision. That's as bad as like Uncle Jimmy at Thanksgiving telling you to buy Nvidia because he thinks it's going to pop, and that's better than putting this money into a house or something like that. It's just always a dumb decision to think that way. So as you invest in collectibles and as you invest in sports cards, just think of the phases of the bubble. Think of the behavior at each of those phases, like fraud and greed and fear, and just try to understand where you are in it and make better buying and selling timing decisions. So hopefully this is helpful. Again, I put that video, the business analysis of Cards HQ. I'll put that video at the end of this if you guys want to check it out. But based on the feedback from that and my experience with finance and economics, people wanted me to put my hat on for a different area of the hobby. So hopefully you found this interesting. If you have any questions about bubble economics or FOMO, leave them in the comments, and I promise I'll get back to you. Thanks, everyone.